Okay, so in this video clip we're going to take a look at how to implement a valuation model for employee stock options, and there has been some recent updating of the American Financial Accounting Standards Board, so we can look at the document in particular here, and there's a number of sections, but this is from 2018, and the standards in the US have been updated to take account of valuation of options, employee stock options to both employees and non-employees. Okay, so there's a couple of sections here relating to the modeling, and we'll take a look just very briefly. And measurement objectives, so this is page 32, but there's a lot in this document, but the section's possibly most related to understanding how to measure objectively the fair value of employee stock options. The measurement objective of equity instruments awarded to grantees is to estimate the fair value at the grant date of the equity instrument that the equity is obligated to issue when grantees have delivered the good, rendered the service, and satisfied any other conditions necessary to earn the right to benefit from the instrument, for example, to exercise share options. That estimate is based on the share price and other pertinent factors such as volatility and grant date. So if we look at the section most relevant here to the model that is prescribed, there's a number of models, but section 718, 10, 55, 16 gives us some insights here. So a lattice model, for example, binomial model, or closed form model, for example, Black-Scholes, are among the valuation techniques that meet the criteria required by this topic for estimating the fair values of share options and similar instruments granted in the share payment transaction. A Monte Carlo simulation technique is another type of valuation technique that satisfies the requirement in paragraph 718, 10, 55, 11. So purely from a modeling perspective, when we look at this, a couple of things of interest. Monte Carlo modeling is important in terms of valuation. The downside of Monte Carlo is that it tends not to produce the same result twice. So because it is simulation and there is a randomness introduced in the underlying, we tend to get a lot of variation then in the results coming from those particular type of models. Black-Scholes model, of course, is the standard model used and introduced in textbooks to students of option theory and fair and valuation techniques. However, Black-Scholes-Merton model is really originally developed for European options, and employee stock options are in fact American in nature, right, or a hybrid between American and European at least. And the most appropriate model is really a lattice model, but historically accountants have not favored these lattice style models, in particular because the models tend to oscillate and don't converge quickly. And a Hull and White 2004 implementation of that model, a very good model, but the model has those issues in terms of oscillation and non-convergence. Okay, and that's documented here with Svitnik, Wiener, Zapatero 2008, and I'll post a link later to that paper. There is also a very good book by Simon Benninga, just generally a good book for financial modeling, and he leaves some code here. He sets up the Hull-White model in that textbook. I've borrowed the code, I've just posted it here. The downside with this, the original Hull-White 2004, is that the convergence is really, really slow. And if you want to read about that further, you can read our paper in SSRN to get a little bit more detail there. But it is an issue surrounding that particular model, that the model just oscillates and doesn't converge quickly. So to streamline a little bit implementation, now again I'm going to follow here the guidance set out in the Financial Accounting Standards Board, and this is 2018 update here. So if we just scrutinize a little bit, it's Financial Accounting Standards Update, and it's June 2018. And the lattice model that we've set out here is consistent with the key variables that are sought after. Again, if we just look at for binomial again and just go a little bit further in to what's expected in terms of selecting assumptions for use in the option pricing model, there has to be an option price, exercise price for the option, the expected term of the option. This should be taken into account in contractual terms of the option, and the effects of the grantee's expected exercise and post-vesting termination behavior. Again, we can capture that. In particular, we don't have to assume an expected term, because that's an output from the model, not an assumption we've got to put in. That's an output from the Hull White 2004 model, which we develop. If you have the current price, then of course you would use that. So the current price we use, the expected volatility we incorporate expected dividends, and the risk-free rate, and we're using fair valuation and risk-neutral valuation techniques in terms of the model here. Okay, so to get a fast and efficient way to set that up in a spreadsheet using VBA code where the model doesn't oscillate, we go to the second segment of code here, so we can just copy directly. And by having it on this portal in this format, generally speaking, we have very few issues then in terms of copy and pasting. Sometimes if you take code from a PDF file and try to copy in directly, then you get issues around formatting, but that we don't have here. So just to note, we've just set up a new Excel workbook. We're going to introduce that. So if you haven't used Visual Studio before, or Visual Basic before, you come over here to the Developer tab. Now, where is the Developer tab? If it doesn't appear, come down to Options, and then look at Customize Ribbon, and just make sure you have that tab ticked. So again, most accountants don't use this tab that much. Most people don't, most analysts don't, but it is a way of setting up your own user-defined functions. If that's ticked, then that tab appears here. We then come over to the very left-hand corner here, click on Visual Basic, and then we have to put in our code somewhere. Now we need to introduce a module, so I insert a module, and then I just paste the copied code, right? And that's gone in here without any issues. So next, just so that we're on the same hymn sheet, we'll just copy the name of the function and the variables that, or the arguments that are going to be used. And that has to be consistent, if you recall, with what was laid out in the FASB documentation. So we said there had to be a stock price, so we would hope that we could obtain the price of the current stock. Now that may not always be possible. Exercise, we have the right to buy an option at the exercise at some future date, the time period, normally long maturity here, There's a vesting period. There's a period initially when you can't exercise the option. That could be up to 4 years. There's an interest rate. There's a volatility, sigma. That's the volatility that we mentioned, we saw in the documentation. We'll include in here a term or an argument for the dividend. Employees leave early if they leave before the options are vested. So if there's a vesting period of 4 years and you leave in advance of the vesting period, you forfeit your option. So this has an impact on valuation. Now, a key feature of the Hull-White 2004 model was that if the value of the stock goes in excess of m times the exercise, then the holder, the grantee, the holder of the option, will exercise early. Okay, so that's something that was early exercise behavior that was mentioned in the FASB documentation. The way Hull and White model that is to put it in as a sort of a barrier specification, that if the stock price exceeds some multiple of the exercise, then you exercise early. So there's no single exercise date. There are many anticipated exercise dates, but if you exercise before vesting, then you forfeit the option. Also important here in the lattice structure, this is a lattice or binomial, we have a number of steps in the model. Okay, so values that we may include in here. Okay, so just initially I'm going to select sort of random values here that do have some kind of semblance of reality about them, but it's not unusual that options would have a life or maturity of 10 years, and they may vest. The vesting period could be 4, but could be less than 4. There would be an interest rate, we'll say 5%. That looks a bit high because currently interest rates are down at close to 0 or 0.5%. The volatility of equity, not unusual for the volatility of equity to be about 20% or a bit less. The dividend rate is equal to, normally dividend payout can be quite low. Let's put it at 2%. The exit could be, perhaps there's a turnover 4% of employees every year. People leave, particularly in high-tech company where skills are sought, and then the multiple, we might go with a value 1.5, right? So that would say if the stock price hits 1.5 times the exercise, that means goes to 150. The option will just automatically exercise in the post-vesting period. And then we'll initially go with a n equal to 100, so 100 steps. And then a very quick way, if we recall here, the way the function that we have here is dynamic truncated Hull-White Boyle, so dynamic. And it is user defined because we set this function up ourselves, so that's the name of the function consistent here. So I'll just double click here, and then a very simple process to follow then is just click on FX, and then that will prompt the arguments to appear automatically. So I